Tom Bowley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Tuesday, September 10th, 2024 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we prepare for yet another trading day. Currently, we did futures were down overnight, but we did see them reverse back up again. But they were hovering kind of near the flat line. So let me see if I can give you the latest there before we get started into some of the charts. Currently, we have the Dow Jones Industrial Average, or the DIA, which tracks the Dow Jones Industrial Average, up about 15/100ths, or about a little bit more than a tenth of 1%. Between a tenth and 2/10. And then we got the spiders up about 0.3 of 1%. The QQQs up 0.4 of 1%. And the IWM is up just less than 0.2 of 1%. So at least we finished fairly decent yesterday. Yesterday was a decent day after a number of days of selling. And now we're off to what looks like to be a gap open to the upside. May not be much, but anything at this point is good. I think we're probably working off a little bit of oversold conditions in the short term. And so this might be something that maybe we can count on for maybe another couple of days. But I would still have my stops in play. The volatility index did come down, close yesterday below the 20 level, which is good. But it's still up there in that nosebleed territory where we have to be careful. This is where we tend to see impulsive bouts of selling. That's why I think it's important to keep stops in play. And if you are kind of dipping your toe back in the water on the long side, maybe trying to trade it up for a few days before that Fed meeting next week. It's not just the Fed meeting next week, by the way. We have inflation reports out this week. We've also got the options expiring at the end of next week. So if we go through this week and we have a pretty nice week, that'll probably be closing the door a little bit on some potential options expiration trades. Because right now, with all the selling we've seen, if we go into next week with the same scenario, I wouldn't be surprised to see at least a short-term pop to the upside, because there'll be so many individual stocks, especially many of those technology names, heavy or high growth names, that trade a lot of options. Those could be deep in the money in terms of the put side, meaning that we could reverse to try and wipe out some of the put premium that's out there. But I'm getting way ahead of myself. We're still talking about 10 days away from being options expiration. I generally don't even look at it until the week of, so I'm not really thinking too much about that right now. But what I am thinking about are the economic reports that'll be coming out this week, and just the basic short-term technical picture of the S&P 500 and the other major indices, and also the rotation. So as we move up, what's rotating? I mean, what's getting love in the current move to the upside, and what's being tossed to the side? I would say clearly over the last couple of months, we've seen more rotation into value, defensive type stocks, and less money rotating in fact, more money rotating out of some of the high octane growth areas, like the technology group, for example. So anyway, that's kind of where we stand. I'm going to go ahead and take a look at some of the charts now for you. Let me make sure I got this set up for you. I don't yet. My bad. Let me get this going. There you go. So we'll zero in here and take a look at the major indices. Just and I like this, being able to pull this up in the candle glance of stock charts, and being able to put up these 12 charts side by side, and putting them up in candle glance form, so you have the last. In this case, I've set up my candle glance to be 6 months. Maybe what I can do, let me show you how you can do the candle glance if you are a member at Stock Charts and you're not familiar. Let's just say this current 10-year yield chart that I have here. Let's say this is the format that I wanted to use for everything. Now, this has got other relative strength indicators on. This is not the way I would set up a basic chart, but let's just say this is, you can set up any chart. Let's just do a default chart. Let me just pull up the TNX. So let's say this is the default chart we want. Price chart, volume, and then the AD line down at the bottom. If you click on this plus, so these are your chart style buttons over here. If you click on this plus button, you can add this chart, and then all you have to do is name it. So if I click on here, it's going to say, okay, chart style description. So you could just say 1 year chart. I mean, that's basically what this is. 1 year with AD. Maybe you have another chart style where you have 1 year with the RSI. Maybe you have another one with just the 1 year with the PPO. I mean, you could type in different names for each of those charts. Now, when I go to type in candle glance, because this is the type of chart I want for my candle glance. So the way you would do that is type in candle glance. Now you can see down below here, mine is already set up. So it's asking me essentially, is this going to be candle glance? If I click on that, then it's going to give me two options: to replace the current candle glance I have, or to just cancel this, because I've already got the candle glance set up. If you don't have the candle glance already set up as a chart style, then you would, I believe the thing, it would just say add new or something like that. You would click on that. In this case, I would click on replace, but I don't want to replace because I like the one I have right now. But that's how simple it is just to set up, one of your chart style buttons. And then you can go in here with the little caret or whatever, the little pointer. If you click on that one, you can reorder. So I could basically, anyway, I could grab that little box with the lines and I could just drag it down to whatever order that I would want it in. Anyhow, let me go back to the TNX here. I just happened to think about it, so I wanted to show everyone how you could do that. All right. So anyway, I set this up. My candle glance is 6 months. I have the AD line down here and I have the PPO on top. I've got my moving averages set up. So this is how I like it's not just short term, like what's just happened. Although if we did a 1 month, we'd be able to see the candles a lot better. So it's just preference, whatever your preference is. I like having the 6 month chart just to kind of get a sense of what's going on with each chart. The AD line, is it supporting the direction that we're seeing on the chart? Is it struggling? Is it a negative divergence where you set new highs in price, but you don't in the AD line? I mean, that could just be like a little slight negative on the chart, depending on how bad that AD line looks. Then you got the PPO to kind of test or check momentum on the stock. Anyway, this is the way I like it. So Dow Jones Industrial Average on Monday finished up 484 points, almost 500 points, back to 40,829. Of course, the high we saw was up around that 41, I want to say 41.6, 41.7 level. I don't remember exactly where it was. But we've kind of moved back up into the short-term range. So we came back down, got close to the 50-day moving average, tested the top end of gap support from back in the second week of August, and now we're bouncing back up. So I think there's a chance that we could maybe on the Dow make a move back up near that recent high. S&P 500 has been hit a little bit harder. I think maybe here you can see that double bottom on the S&P coming in around 55.50. Maybe we make a little bit of a move here over the next few days, get back up near that level. I mean, it's possible we could go back up, test the recent highs. I mean, there's always the possibility you break out. I just don't think it's happening in September. I would put lower odds on that. But I do think that there's a chance that we get back up to about 55.50 on this move to the upside in the short term. Of course, the very, very near term is the hardest to predict. A market can do anything from day to day. I'm just looking at the chart saying, okay, we broke down below that double bottom in the second half of August. So it kind of makes sense. We've already gone back up there a couple of times and gotten back close, couldn't get through. So getting back up there again would be probably the next key area of resistance, along with the moving averages, of course. What I'm already seeing, though, in most of these charts is that the moving averages aren't holding in one direction or the other. We're going down below, we're back up above, we're down below, we're back up above. And so I look at this and I see sideways consolidation, rectangular consolidation, a trendless market environment in kind of the intermediate term. Short term, we were downtrending. Now we kind of tried to flip yesterday. Maybe short term, we started a little uptrend. I'm talking about the intermediate term over the last couple of months. What I see is just sideways consolidation. And when I see that, I don't pay as much attention to the moving averages. I mean, we can talk about it, but once you go through them multiple times in a short period, they're really not acting as support or resistance anymore. So until we actually make a breakout, come down, test the 20-day, hold it, and make another breakout, there's no real trend, intermediate term, really, that we can count on here. So I'd look for a little price resistance, like I just talked about, that 55.50 level. But anyway, S&P 500 yesterday up 62. So you can see on a percentage basis, Dow up 1.2, S&P up just a little bit less than 1.2. NASDAQ showing a little bit of leadership yesterday, climbing 1.3. But you can see as we go across the board, as you get more aggressive in terms of the indices, the uglier the charts are, because the relative strength, the rotation that we've been seeing, all has favored the Dow, for instance, over the NASDAQ. I mean, look at the highs. NASDAQ never came close to that early July high or mid-July high. The Dow set new highs. So, I mean, just looking at that, you can come to a very quick conclusion that money's rotating away from the NASDAQ and into the Dow. Dow is much, a lot of bigger, these large behemoth companies that are got their hands in just about every different area, sector of the economy. They're very big, tend to be more slow moving. We do have technology names in there like Apple and Microsoft and Salesforce, companies like that could, be at, or you could look at those and say, hey, those are more momentum plays. They can move pretty quick, but still they're huge companies, massive companies. So the Dow tends to be a little bit safer in terms of, drawdowns, but they also can act, as you can see, as a little bit of buffer when growth goes out of favor. And that's what we've been seeing, I think, here over the last couple of months. Moving on, mid caps up about 0.5%, small caps only up a quarter. So the small and mid caps, once again, kind of being tossed to the side. It's really, I like the IWM, and the IWM relative to the QQQ, the rotation's been positive. But if there's a negative, it continues to be the AD line on the IWM. I'm not quite sure why. Technical analysis, I always learned you don't ask why questions. You just look at the price action and it is what it is. So I tend not to ask why. What I can see here is that the AD line on both mid caps and small caps still not great. I mean, we saw back in July when we got that June CPI report, the initial move to the upside was heavily supported by rotation, or not rotation so much as accumulation, where the IWM not only was going up on heavy volume, but it was closing near the high of the day. That's really not been the case since mid-July. So even though I remain bullish the IWM, I'm not getting confirmation from the AD line, which means I want to, be cognizant of the possibility that I'm wrong. And if I'm wrong, where am I going to draw the line? Clearly, you got a couple bottoms down here on the IWM around 198, 197. That's a key support level on the IWM. If the AD line's going down and other major indices are going up, and you lose support on the IWM, then it's starting to tell us, it's giving us a different narrative. The charts are telling us a different story. So even if you make calls in the market, you've got to be willing to accept when they go against you. At this point, I'm still okay with the IWM. I mean, I'm not in it. I didn't like this move back down below our moving averages, ended up getting stopped out. But I still favor the IWM when the market settles down, when I think we have a tradable bottom, more of a, I'm not going to say long term, but maybe more of an intermediate term tradable bottom. Then I'll be looking to get back into the positions I had prior, and I'll determine at that time what kind of weighting that I want to have on them. But I do believe that the lower interest rate environment will favor small caps. And so we'll wait. We'll see what happens. But for now, certainly yesterday, the group did not perform well. That asset class did not perform well relative to its larger cap counterparts. Transports gained 1.35%. That was good because this was a group that was rolling back over. All of a sudden came back up again. Again, its AD line's not strong. If we go back and look at the others, NASDAQ, not too bad considering how sharp these declines were. I think the AD line's held up pretty well, and I fully expect it's going to go back to an all-time high when the S&P 500 reverts back to an all-time high. And I think that could be as soon as the fourth quarter. S&P 500 AD line maybe a little bit weaker. Looks like it's fallen a little bit because we almost got back to equal highs. I think the lows there were a little bit more. I think you can see that they were further apart than the price action. But look at the AD line on the Dow continuing to be strong. If we move down to some of the key industry groups, we had three that led yesterday: technology, industrials, and financials. I would say all of these are okay. I would prefer to see the industrials and financials doing better because they saw highs. They did not see highs on the AD line. So that might be an indication maybe that it's shorter term than what I think. There's still a lot of, if you're kind of catching my drift, there's still a lot of questions to be answered. And as the market changes, it'll give us some of those clues. There's enough to be concerned about where you could justify continuing to remain in cash simply because of history. Number one, we know September into October, worst period of the year. And really since mid-July. Mid-July is really when the worst part of the year kicks in. That goes from July 17th close to September 26th close. We're getting closer to that September 26th level. Still got a few more weeks to go, a little over a couple weeks, I guess, 2 weeks, 2 days to get there. And maybe things will start to change then. But I think we always need to respect the historical weakness that comes up in the second half of September, especially the 20th to the 26th. That's the second worst week of the year historically. Does it mean it goes down? The S&P 500 goes down every year between the 20th and the 26th? No. Don't take that literal. Don't take that as a guarantee. Understand the tendency. So in other words, if you're long and you're between September 20th and 26th, the market starts to fall apart and the VIX goes back up through 20, I'm not going to be the hero that tries to be in on the long side and hit that exception to the rule where the market takes off. Again, that's just me. It's the way I try to use, my risk analysis to determine whether or not I should be in the market or not. And right now, history tells us it's still very, very risky, probably for at least the next month or so. Looking through here, airlines had a nice move, but you can see that AD line going down. But airlines were up 3.5% yesterday, so that certainly was helping the overall indices, especially the Dow. You got the wireless or mobile communications group, which has been going straight up not straight up, but has consistently been going up, unlike some other areas. This is a group that just recently broke out beginning of September to the upside. That AD line looks pretty good going up with it. So this group, I would say the 20 to the 50 provides pretty good support. Going back since the latter part of May, we've only had one period where we've gone below the 50-day moving average. So this is an area that certainly has been getting its share of rotation into. And it tends to be a little bit more of a defensive area of the market as well. But the mobile communications, you can see up almost 3% yesterday. Good day there. Semiconductors. I haven't talked about them in a positive light very often, and definitely not over the past 2 or 3 weeks. But yesterday was a decent day. We gapped up, pulled back a little bit, and then actually finished pretty strong. But I want you to look at this AD line. If you think semiconductors are dead, I would just caution you about that thinking. I think it's kind of like, Bermuda grass going dormant in the winter. I kind of feel like semiconductors are dormant. And when the market's spring weather hits, not really spring, but when we get past September and October, I would not be surprised to see maybe in November, semiconductors kind of come out of a funk and take off again to the upside. I'm not sure if this group breaks out, but I think they could go back up and challenge highs or get close to it. But again, I think that's a little bit further down the road. I think that comes after a rate cut or two when the market starts to project economic strength down the road, maybe 3, 6, 9 months out. And when the market starts to sense that, you're going to see areas like the semiconductors take off to the upside. So anyway, I'm looking at this AD line thinking, wow, semiconductors, yeah, they've been looking bad for the last month and a half, maybe even going back a couple months to June. But AD line isn't bad, which is telling me that as we're seeing these pullbacks, we've still got plenty of buyers that are willing to step in during the day and accumulate these stocks as they go down. Now, I've written articles, just in case I'm probably confusing everyone. I mean, I did a stock chart show last week, and the title of the show was, NVIDIA to $50 with question mark. I mean, I think that's a possibility. I don't think that's the likely. I think it's definitely a possibility. If things were to get really bad over the next 30 to 45 days, I could see that happening. But I'm not banking on it. I wouldn't sit back or start putting in my limit orders for $50 or $51. Could it go down to 75 during a couple of weeks of bad market weather? Yeah, I think 75 is definitely a possibility. If we lose that August 5th support, which is down in the low 90s, you could see NVIDIA take a little bit more of a hit. But if we do, continue to watch the AD line. I mean, if it falls apart and the semiconductors fall apart, then maybe it'll be a lot longer climb than I think back to the upside. But right now, I mean, we're going back down. We've had closes back down close to the low close at the beginning of August in this group. So if I pull up this group, remember, closes, when you have these hollow candles, the close is at the top of the rectangle, not the bottom. So if we put this on a line chart, you can see semiconductors on a closing basis aren't far from breaking down below the August low. So this is an area where maybe we get a little bit of a reprieve. Maybe we go back up, test that 20-period moving average before we have another low coming later in September, early October. Very possible. And all we can do is look at the charts and kind of come up with different scenarios. I mean, there's no way to say for sure whether semiconductor is going to break down again. I mean, that's just beyond my pay grade. I think they're weak. They're certainly killing the NASDAQ 100 right now. I mean, that's the semiconductor group is about 25% of the NASDAQ 100. So when you see a group like this, down near a 1, 2, 3, 4 month low, of course the index that it's in is not going to do as well. Now, semiconductors only represent 11% of the S&P 500. That's why the S&P 500, one of the reasons why the S&P 500 is doing so much better. And outside of Intel, there's no semiconductors in the Dow. So you've got, almost no representation in the Dow of one of the worst performing groups. So if you're wondering why the Dow is outperforming, you might be looking at some strength. I'm just going to say that the key areas of weakness, the aggressive growth semiconductor area, has a lot to do with what's been outperforming. It's not so much what's been leading. It's a lot about what's been lagging. So anyway, just a different perspective there. 10-year Treasury yield. So let's see, this morning, really nothing out in terms of economic reports. It's if the start of this week really quiet. We had almost nothing out yesterday, nothing out today. Things pick up though tomorrow. We have the CPI report out tomorrow. On Thursday, we've got initial jobless claims, and then we've got the PPI on top of that. And then on Friday, we'll get consumer sentiment. So things pick up from an economic perspective. I've said, more recently, I think now that the Fed has said, hey, it's time to adjust our policy. They've said all along they have to feel really good that that inflation is making a sustained move toward its target level. Now they didn't lower they didn't lower in at the end of July, but then from Jackson Hole, remember, Fed Chief Powell said it's time for us to adjust our policy. So I don't know if something happened in that 3-week period, 3.5 week period that changed his mind, but all of a sudden he came out of Jackson Hole and said, hey, we feel pretty good, and now we're ready to start cutting rates. That was a pretty big shift for them finally to get over that hurdle. And with these inflation reports coming up, how much weight are they going to carry now that the Fed says, hey, our mission is accomplished? I mean, I think there's some saying, well, if the inflation report comes out, maybe the Fed's going to change its tune. I don't think it's going to. I mean, if they do, then we got some real problems with the Fed. If they're flipping on each individual economic report, whether they're going to raise or cut or keep things the same, then I don't think they're really doing the job best that they can do. Just my opinion. But I think they've signaled to us that, hey, they're not concerned about inflation anymore. I mean, obviously they're going to watch it. They're not going to ignore it. But I just don't think, one pop in inflation higher than expected, maybe the market sensationalizes it and we do see a sell-off short term. I don't think that changes Fed policy, though. So anyway, I don't think it carries as much, that the inflation reports are going to carry as much significance going forward. I think it's going to be the economic reports that tell us whether or not the economy is weakening, whether the odds of a recession are growing, because now the Fed is saying we're turning our attention to the economy. We're turning our attention to jobs, making sure that the economy now doesn't fall back into a recession, or if it does, that it's a mild one and we come right back out of it. That's my interpretation of everything that's been taking place. So anyway, as I look at the 10-year Treasury yield, you can see it's back down near the low. Trust me, 10-year bond investors, those who are looking at buying or selling bonds, when interest rates are going down, when the 10-year Treasury yield's going down, it means bonds are being bought. Who in their right mind would be buying a bond at 3.7% if you really thought inflation was a problem? The bond market's been telling us for a while inflation's dead, or that it was on its way to being dead. Now it's basically dead. And so I'm not going to ignore what all these charts are telling me. I'm certainly not going to ignore what the Fed just told me a few weeks ago. They're ready to change their policy. The inflation is not a problem, which is what the bonds market's been saying for a while, and the same thing I've been saying for a while. But Fed is on their own schedule. They do their own thing, and they decided now's the time. So we'll go with that. Hopefully they didn't leave the rates up too high too long. That's what we're going to find out over the next couple months, is how much economic deterioration we see. Jobs report, by the way, that just came out beginning of September, the first Friday, we missed. We came in a little bit below, but we also lowered the jobs for the prior 2 months. And remember, jobs were lowered 800,000 back for the year ending March. So even though we're positive, is it possible that our positive number in a month or two gets lowered and maybe it's negative? I mean, I don't know. Government, we've had a history recently of seeing the government overstate the jobs numbers. So all food for thought. Anyway, S&P 500, you can see, looking at that longer, or the that candle glance picture, it looked like, hey, we're in this uptrend. We got maybe a little bit of work to do on the AD line here, but overall, I mean, you can see the AD line continues to go higher over time. I'm sure there have been plenty of times when we've broken out and the AD line hasn't been perfect. Maybe back, I don't know where the high was on the AD line going into September last year. Anyhow, what we'd want to see is if and when the S&P 500 break out again to the upside, I want to see that AD line go up with it. So overall, you can see now we're back downtrending, but we've had roughly equal highs. I think probably somewhere around that 51.20 level, that low that we saw in August. If you had to say, okay, what's your most likely target, or what's your most likely downside scenario? I'm going to say 51.20 would be my lowest downside. I mean, if we're going down and I had to pick one of these levels, I'm going to say the most likely one is maybe just a tad below the August low, because a lot of times that scares folks when they lose a major support level like that. So maybe we dip below 5,100. I don't know if we're going any lower than that. I've stated some cases for going back to test the breakout above 48.20. That was the high, I think. I don't remember when that high was. I'm not going to keep going back because I want to keep going forward in the show. It's almost 9:30. But there were 48.20 was a big breakout. We haven't gone back down to test that. So that's a possibility. You can see the April low went down just below 5,000. That's a possibility. Maybe we go down very quickly below both of these with the VIX going up in the 30s or something. That's a possible scenario. The reason that's so hard is if you're expecting selling, then chances are the VIX is going to go up. And when the VIX goes up, you can have impulsive selling. I might think this is a great support level, and the VIX might be at 34 and go through that number at least intraday like it's a hot knife through butter. So I think down around that level is where I would at least begin nibbling at stocks. I just think that if we get down to that 48.20 to 51.20 range, I think that is a really strong range to be building positions in. After the top, which came back in mid-July at 56 and change, 56.70 or whatever it was, that'd be a pretty big correction back down to that level. So again, I'm just thinking ahead, looking at possibilities so that I'm prepared for whatever happens. No guarantee we're going back down there. I just think late September, early October, presidential year, it would be unusual if we just took off from here and broke out to the upside ahead with all that uncertainty and how much the Fed's going to cut and how bad's the economy going to get. I think that uncertainty is what leads to weakness in the market. And so I still think we're going to have at least another bout of downside action, even if we do rally here over the next day or two, a couple of days. Anyway, NASDAQ 100, we talked about that. I won't go into that. IWM, we've moved back down below the moving averages, which again, we've been going up and down. So I'm not really too concerned about that. The one thing I am really concerned about, though, is the support level down around 197, that August 5th low. I mean, if we're showing relative strength and money is rotating into the IWM relative to the NASDAQ, then we don't want to go back down to the August 5th low, which is, if the NASDAQ goes back down there, we want to see rotation. So we don't want to see a move all the way back down to that level. We do have a gap support level in the IWM that comes in 206 and change. Maybe keep an eye on that. But if we fail that, I mean, there's really not a lot of support until we do get down to that early August low. Transports just continue to go sideways. We've been head faked so many times. I really don't even want to make a call here. What I would simply say is that if you look back at, say, the 5-year weekly chart, you had a move up before all this consolidation. So we normally would break in the direction of that prior move. If you look at a monthly chart, I mean, it looks like a pretty nice uptrend, doesn't it? Been going up for years. We're just sideways consolidating and probably going to get a massive breakout. That's if I was looking at a price chart of a stock, I would look at this long-term chart and say, yeah, this looks like a really good chart. Equal highs, rising lows. You got a nice ascending triangle off of this uptrend. Yeah, this thing looks like it could explode. That's what I would say. So I look at it now. When we look at it on a daily chart, it looks horrible. But you look at it on a monthly chart, and perspective tells us that, hey, this thing could have a really nice late 2024 and 2025. All right, earnings beats. Go over, if you haven't already, sign up for our free Earnings Beats Digest newsletter. Name, email address is all it takes. Completely free, no credit card. You can unsubscribe at any time. All we do is try to come up, look at the market, look at individual stocks the way we do at Earnings Beats. Maybe it'll help you in your trading. We try to make this an educational newsletter, but certainly there are potential trades. That's up to you. We take no part of it. You got to be responsible for your own trades. I simply will point out some stocks that look interesting to me from time to time that I think could be at a key buying point, or maybe looking for a breakout, or maybe just pointing out a leader in a certain space. Anyway, you can go to earningsbeats.com, scroll down, be sure to check out our free EB Digest if you haven't already. Also, start your no-cost trial, 30 days. You want to get all my thoughts on what I think the market's doing over the next 30 days? Best way to do it is with a 30-day trial. We have a lot of information that we share with our members. I think you'll enjoy it. And if not, in the 30 days, we part ways, no harm, no foul, and no money as far as you're concerned. Anyway, check that out. All right, looking at some of the stocks. This was before the market. Well, actually, I guess it is the market opening. We got the Dow or the NASDAQ right now. Let me just refresh, make sure we got everything, because we did just open. Actually, we opened 4 minutes ago, so it is. So we got NASDAQ up 3/5, 0.6 of 1%. S&P 0.3. The Dow down, small caps down. So we're seeing a little bit of a flip back the other way. Amazon having a pretty good day today. So let's just wanted to see. Let me see if I can find one that really looks good here on the list. All right, I'm going to take a look at CRM, because if you notice, CRM has a key resistance level right here. This was the gap. We gapped down on massive volume. Then we came back 3 months later, another earnings report, gapped up with the earnings report, but notice right at that same level and then back down again. We do have a trend line. What I would say is that if the market does start to strengthen here a little bit, CRM can get through 250, which is the resistance over the last 5 days. I think it could maybe it runs back up to that 270 area. So this is one that maybe if it gets through 250, I would be okay with it, especially if it looks like the market overall is repairing itself a little bit here. I could trade it on the long side with maybe a closing stop below about 244. So I wouldn't have to give up but a couple percent. You could do a small position, doesn't have to be a big position. In fact, most any individual stock position that I did right now in September on the long side, almost guaranteed would be a small position. I'm not doing normal positions right now. Not with what I know about September, all the risks I talked about earlier with the Fed and the interest rates and, the presidential election and so forth. I think it would be a little bit I don't think it's a good idea to be overly aggressive on the long side. Again, just my call. The way I look at things, risk plays a big role in my trading. When I think the market's risky, I immediately will either shut down, go to cash, or if I trade, I'll trade fewer shares. Sometimes I'll trade the ETFs instead of individual stocks, those types of things to try and manage my risk in uncertain trading periods like this. Anyway, I thought that was a pretty good one. One that if it starts to turn, could maybe head for that level. And if we get through 270, I think Salesforce makes a run for that high back at the end of February, early March, closer to maybe about 316, 317. Anyway, that is essentially going to be it for me. Let's get one final look at the market, see what's going on. S&P and NASDAQ already have dropped a little bit. Small caps back up to the break even, at least on the SML. I don't know about the IWM. IWM actually looks like it's just down a little bit. If we pull up a 10-minute 5-day chart, you can see we started off and then came back up. QQQ actually started up and came back down. So we're seeing the early morning action favoring the larger cap QQQ. But what we've seen, and one of the reasons I said earlier that the rotation continues to favor the IWM versus the QQQ, is that sometimes we do see the strength on the QQQ in the morning and weakness on the IWM, and then they flip during the day. So during the day, QQQ goes back down, IWM comes back up, and that's how you can see sometimes some rotation. So for instance, like the IWM QQQ, it's down here, but it's already coming back off the low. Look at yesterday when we gapped down and then made a big move back up. This is just a ratio. So this is just showing you rotation. What I like to look at sometimes is just how it goes during the day. Is it flat? Is it go up all day? Does it go down all day? I mean, for the most part, we did see a little bit of selling yesterday afternoon late in terms of rotation away from the IWM and into the QQQ. But for the most part, I mean, we've seen some initial moves in the morning to the downside, but overall, I think the IWM's held up pretty well versus the QQQ. See it maybe a little bit differently if we go back hourly and go back a couple of months, but this was since this was the Jackson Hole speech, 10 a.m., August 23rd. And we went up initially, and we've been kind of going sideways, holding our own since then. So it hasn't been a bad thing for the IWM. But then I see like that AD line that we talked about, and that makes me a little nervous. Anyhow, still a lot of questions to be answered. And I'm sure we'll be getting some more of those questions answered over the next few weeks. And as I see them and as I see the signals, I'll be sure to pass them along. Anyhow, everybody have a great day. Enjoy the rest of the day and the rest of the week. Remember, we've got inflation coming up, inflation reports next 2 days. So check those out, and we'll see how the market rolls as we head toward options expiration week next week and the Fed. Have a great day, everybody. Happy trading.